You open your phone, scroll past another investing ad, and think, I'll start investing when I have more money. Maybe you're waiting to save up $1,000, maybe $5,000. Maybe you're waiting for things to feel more stable, more certain, more ready. But here's the problem. That moment never comes. And every month you wait, you're quietly losing something you can never get back: time. Because here's what most people don't realize. The most powerful investing habit in the world doesn't start with thousands of dollars. It starts with $50. My name is Mark. If you've ever told yourself you'll start investing later, make sure to hit the subscribe button and give this video a thumbs up. Because today we're going to change how you think about that. Let's start with the uncomfortable truth. Most people believe investing is for people who already have money. And honestly, that belief makes sense, because every investing ad shows yachts, luxury apartments, and guys in suits staring confidently at stock charts. It looks like a club you need a lot of money to join. But that's not how wealth actually builds. Not for most people anyway. Here's what actually happens. Wealth builds quietly, slowly, through one boring habit, repeated consistently. And that habit doesn't care whether you start with $50 or $50,000. It only cares that you start. Let's look at the math, because the numbers here are genuinely surprising. Imagine you invest just $50 every single month starting today. That's less than $2 a day, less than a single takeout order per week. If the market returns roughly 10% annually, which is close to the S&P 500's historical average, here's what happens. After 10 years, you've contributed $6,000 of your own money, but your account doesn't show $6,000. It shows closer to $10,000. After 20 years, you've put in $12,000, but your balance, nearly $38,000. After 30 years, you've contributed $18,000, and your account has grown to over $113,000. Same $50 habit, completely different outcome depending on when you start. And this is where most people's brains short circuit, because $50 feels insignificant. It feels like it couldn't possibly matter, but compounding doesn't care how it feels. It only cares about time. Here's a quick analogy. Imagine you're rolling a snowball down a hill. At the top, it's tiny, almost laughable, but as it rolls, it picks up more snow, more surface area, more momentum. By the bottom of the hill, it's enormous. Compounding works exactly the same way. The snowball is your investment. The hill is time, and the longer the hill, the bigger the result. But here's where it gets really interesting, because the $50 habit isn't just about the money it makes, it's about the habit it builds. Most people who start investing $50 per month don't stay at $50 forever. Something happens psychologically once you start. You begin watching your account grow, slowly at first. Then you get a small raise at work. Instead of spending it all, you bump your contribution to $100, then $150, then $200. Now, you might be thinking, okay, Mark, but where do I even put $50? What do I actually invest in? Fair question. For beginners, the simplest and most reliable starting point has historically been broad index funds. These are funds that track the overall stock market, like the S&P 500. Instead of betting on one company, you're spreading your money across hundreds of companies at once. Lower risk, built-in diversification, and historically, strong long-term returns. Warren Buffett himself, one of the greatest investors alive, has publicly recommended low-cost index funds for everyday investors. Not options trading, not crypto speculation, not picking individual stocks, simple, consistent index fund investing. And here's the part that surprises most people. You don't need a financial advisor to start. Platforms like Fidelity, Vanguard, and Schwab allow you to open an account and start investing with as little as $1. The barrier to entry has never been lower. The only real barrier is the story you're telling yourself about not being ready. Let's address the obvious concern. But Jack, what if the market drops right after I invest? Completely valid worry, and here's the honest answer. Markets do drop. They always have. But here's what history also shows. Every major market crash in the last 100 years has eventually recovered, and investors who stayed consistent through the drops, who kept putting in their $50 every month even when headlines screamed panic, those investors came out stronger on the other side. Because when markets drop, your $50 buys more shares at lower prices, which means when markets recover, your gains are even larger. Consistency during volatility is actually an advantage. So here's the simple truth about the $50 habit. It's not really about $50. It's about removing the story that you're not ready. It's about proving to yourself that you're someone who invests. Because identity drives behavior. Once you see yourself as an investor, everything shifts. The path is simple. Open a brokerage account, Set up an automatic $50 monthly investment into a broad index fund and leave it alone. That's it. No complicated strategy, no financial expertise required, just the habit, repeated consistently for as long as possible. Because 30 years from now, the version of you that started with $50 today will look back and realize that the small decision was never really small at all. If this video helped you see investing differently, hit the subscribe button. And I'm curious, what's been your biggest barrier to starting? Let me know in the comments, because the best time to start was yesterday. The second best time is right now.